You've been taught to recognize candlestick patterns, but not how smart money actually uses them. In this video, you'll discover how to read candles the way the banks do so you stop falling for traps and start trading with precision. Here's what you'll learn: the deceptive candle, the fakey pattern, the engulfing trap pattern, the silent flip, the silent drop, the green wall setup, and the red wall setup. By the end of this video, you'll know how to spot these secret smart money candles, how institutions use them to trap, mislead, and dominate, and most importantly, how to use them in your favor to make high probability trades. Before we dive in, make sure to like, subscribe, and hit the bell so you never miss another smart money strategy. Let's get into it. The first pattern Munahisa Homer used to read market emotions is what I call the deception candle. It's also known today as the pin bar, and if you're not careful, it's the candle that can either make your account or break it. Here's how it looks. A small body near one end and a long wick showing strong rejection. It tells us price tried to go somewhere but was slammed back. Retail traders often see this and get excited. They think, that's a breakout, I'm jumping in now, but smart money thinks differently. They use this candle to manipulate emotions, to lure traders in, take their stops, and then reverse the market. Now that you understand what the deception candle is, let me show you 3 ways smart money uses it to trap retail traders and validate powerful zones. Look at this chart. Price taps this level and reverses. It pulls back again, taps it, and reverses once more. Now we have a strong support level forming. The market pulls back again, and this is where retail traders start setting their traps on themselves. They place limit buy orders at the support level, expecting the market to bounce one more time and go up again. They're convinced this is a clean retest. Some enter early, others wait for confirmation, but almost all of them hide their stop losses just below the support. And what happens? The market spikes below the level, grabs their stop losses, forms a perfect pin bar, and then reverses aggressively to the upside. That's not a failed setup, that's a liquidity trap engineered by smart money. If you understand how this game works, you don't panic when your stop gets hit. You re-enter confidently because you recognize what just happened. The pin bar wasn't rejecting your idea, it was clearing out the weak players before the real move began. Now let's look at how smart money uses the pin bar to confirm powerful zones. Here's a chart. The market moves up aggressively, leaving behind a clean demand zone. What happens next? Price returns to that zone and gets instantly rejected, forming a well-shaped pin bar. This is key. The rejection tells us that limit orders were waiting. Smart money didn't chase the move, they were waiting patiently. That pin bar acts like a signal. More institutions see the reaction and jump in. What happens next? The market explodes upward. Here we have a strong supply zone. Now, how do we know it's real and not just a random pause? We apply our criteria. Look at the size of the candles in the move down. They're big and impulsive. That shows institutional interest. The zone is fresh and the previous support is broken. Now we know this isn't just noise. This is a smart money zone. Watch what happens. Price pulls back, taps the zone, and forms a clean pin bar. That's not coincidence, it's confirmation. The wick shows limit orders were triggered. Other large players jump in, and price drops aggressively. The fakie is one of the most powerful smart money candlestick patterns and one of the most dangerous traps for retail traders. It looks like a breakout, it feels like a breakout, but it's not. It's a setup designed to trap breakout traders and leave them stuck on the wrong side of the market. Let's break it down step by step. First, the market forms an inside bar. That's when a small candle forms completely inside the previous candle's high and low. This shows consolidation. The market is pausing, waiting for the next move. Then, price breaks out of the inside bar. Retail traders get excited. They jump in, thinking a new trend is about to explode. They enter, set their stop loss, aim for their target, but they're walking into a trap. Suddenly, the market snaps back, closing back inside the inside bar's range. That's fakey. A fake breakout followed by a real move in the opposite direction. And just like that, breakout traders are stuck, and smart money is in control. Now, let's look at a few variations of the fakie that smart money uses to trap even more traders. The bullish fakie. Price fakes a break below the inside bar. Retail traders panic and go short, but then the market snaps back up and explodes higher. The bearish fakie. Price fakes a break above the inside bar, buyers jump in, thinking it's the start of a breakout, but price quickly reverses and collapses downward. The multi-bar trap. Sometimes the fakie forms after 2 or 3 small candles following the inside bar. This creates a deeper trap, giving traders more time to believe in the breakout, which makes the reversal even more painful and more powerful. Look at this chart. You can see the market hits the level and reverses, pulls back, hits it again and reverses, then pulls back once more, hits it a third time and reverses. Now we have a clear support level forming. Price pulls back again. And this time, we get a fakey setup, a textbook smart money trap. Price fakes a breakout below the support, drawing in breakout sellers, then quickly snaps back inside the range. That's our signal. You can enter at the close of the fakey candle, place your stop loss just below the wick, and aim for the next logical target. Now look at what happened next. As expected, the market reversed sharply and moved straight in our direction. That's the power of spotting the trap before the real move begins. Look at another chart. The market pushed up, hit this level and reversed, creating a key resistance zone. Price pulls back again, and as it approaches that level, a fakey pattern forms. This is where smart money sets the trap. We see an inside bar, signaling indecision, and then a breakout above it, which tricks buyers into thinking the market is ready to break higher. But here's the catch. Price quickly closes back inside the mother bar's range. That's the confirmation. The breakout was fake. Now that we've spotted the trap, we can anticipate that the price is likely to move down. The setup is simple. Enter at the close of the fakey candle, place your stop loss above the wick, target the next key support level. And look what happened next. Just as expected, the market dropped cleanly and hit our target at the next support level. Another example of how smart money uses the fakey to trap traders and take control of the move. The engulfing bar is one of the most aggressive reversal signals in price action, but it's also one of the most misused by retail traders. On its own, it's just one candle eating the previous one. But when it forms after a liquidity sweep or at a key zone, it becomes a clear signal of smart money stepping in. Engulfing bars show up at turning points, and when used correctly, they tell you that the previous move is done and the market is ready to reverse. But to use it with precision, you need to understand the two types of engulfing bars and what each one is really saying. A bullish engulfing forms at the bottom of a move, usually after a sharp sell-off. The first candle is bearish, showing selling pressure. Then, suddenly, the next candle is a strong, bullish bar that completely engulfs the previous one. This shift in momentum shows that buyers have taken control. But remember, it's most powerful when it forms after a stop hunt or at a fresh demand zone. A bearish engulfing forms at the top of a move, often after a strong rally. The first candle is bullish, full of buying pressure. Then the next candle erases that strength with a big, bearish move that engulfs the previous candle completely. This signals that smart money is selling into the strength and that a reversal is likely, especially if it happens after a liquidity sweep above resistance or inside a supply zone. To truly understand the engulfing bar, you need to go beyond what it looks like and focus on what it represents. It's not just one candle covering another, it's a shift in control. A moment when smart money takes over and traps traders who are on the wrong side of the market. Let's break it down using a bullish engulfing bar as an example. The market is in a downtrend. Sellers are in control. Retail traders see price dropping and start entering short positions. Then comes a small bearish candle. It forms right after the move down. It looks normal. It gives the illusion that the trend is still healthy, that there's more room to fall. So what do retail traders do? They jump in short again. They place stop losses just above the high of that small candle. They're confident the market is about to make another leg down. But behind the scenes, smart money is watching. They're not selling. They're waiting. They know the stops are stacked just above that candle. So the next move is precise. A big bullish candle forms and it engulfs the entire body of the previous bearish candle. In just one candle, everything changes. That's the bullish engulfing bar. A signal that sellers have lost control and buyers are stepping in with force. But what's really happening here? Smart money uses that small candle to bait sellers. They trigger their entries, wait for stops to build up, then reverse the market and take liquidity. Retail traders panic. Some close in loss, others flip their position too late. And while the crowd is reacting emotionally, smart money is already in, riding the move they created. That's why an engulfing bar is never just about its shape. It's about where it forms, when it forms, and who gets trapped because of it. Understand that, and you stop trading like the herd and start thinking like the pros. Look at another example. The market makes a strong move to the upside and hits a level, then reverses sharply. That rejection gives us a clear resistance level. Later, price pulls back again and breaks through that resistance. This breakout looks like a textbook buy setup for retail traders. They get excited, they place their entry at the breakout, set their stop loss just below the level, and mark their targets higher, expecting the trend to continue. But watch what happens next. Right after the breakout, the market prints a strong bearish candle that completely engulfs the bullish breakout candle. This is your bearish engulfing bar, and it's not just a reversal pattern. It's a liquidity sweep engineered by institutions. They know exactly where breakout traders will enter. They know where the stop losses are hiding. So they let the market break the level, trap the late buyers, and then slam price back down, stopping out retail traders in seconds. From there, the market reverses hard in the opposite direction, leaving retail traders on the wrong side, and smart money riding the move they planned all along. The silent flip is a smart money reversal pattern that forms at the end of a downtrend, but unlike flashy breakouts, it signals a shift quietly just before the real move begins. This pattern tells you one thing: the trend is about to flip, and smart money is already preparing. The silent flip is made up of 3 candles, and when it forms at the right location, especially after a liquidity sweep, it becomes a powerful entry trigger. Here's how to spot it. The market must be in a downtrend, or the move leading up to the pattern should be clearly bearish. The first candle in the pattern is a strong bearish candle, showing clear selling pressure. Retail traders are fully convinced the downtrend will continue. The second candle has a small body with a long lower wick. This candle triggers limit buy orders. It's where smart money quietly steps in, absorbing sell-side pressure without revealing their hand. The third candle is strong and bullish. It closes well into the body of the first bearish candle, ideally above its midpoint. This candle confirms that the flip in sentiment has happened. Buyers are taking over. The silent accumulation is now turning into an explosive move. Now, let's look at a real chart example. This is the Australian dollar against the Canadian dollar on the 15-minute chart. The market was clearly trending down. Sellers were in full control. Then, price hits this level and gets rejected hard, forming a temporary support. Now watch closely. Price pulls back, and this time it breaks below the support. At that moment, retail traders are fully convinced. That's the breakout. The market's going lower. They start placing sell entries at the close of the candle that broke the support. Others get more aggressive, placing limit sell orders just below the breakout candle, and almost all of them hide their stop losses just above it. But what happens next is where smart money shows up. Suddenly, a bullish candle forms. Then another, even stronger bullish candle follows. That's the silent flip in action. 3 candles, 1 engineered trap. Smart money first breaks the level to trigger retail entries, then pushes price back up to trigger the limit orders, and finally uses the third candle to hit the stop losses. And just like that, retail traders are trapped. The move they thought was a breakout was just a setup for the real reversal. From there, the market flips direction and starts trending upward, leaving smart money in control, and retail traders stopped out and confused. Look at another chart. This is the New Zealand dollar against the US dollar on the 15-minute time frame. The market was clearly moving down, until it hits this level aggressively and reverses, leaving behind a clean demand zone. Then price pulls back again and reaches the zone. And this is where the silent flip candlestick pattern appears. Let's break it down. The first candle confirms that bearish momentum is still present. It also triggers limit buy orders from traders who are betting on the demand zone to hold. The second candle dives deeper, breaking below the zone. This move is designed to trigger stop losses sitting just below the area. And then comes the third candle, a strong bullish candle that confirms the momentum flip. This is the silent flip, a smart money move designed to fake out retail traders, sweep liquidity, and reverse the market with precision. Once you spot this formation, the entry is simple. Enter at the close of the third candle, place your stop loss below the second candle, and target the next resistance level. Now look at what happened next. As expected, the market reversed and pushed up strongly, because smart money had already cleared the path and flipped direction. The silent drop is a smart money candlestick formation that signals a potential bearish reversal. It's designed to catch breakout traders off guard, especially after a strong move up. The pattern is made up of 3 candles, and together they tell the story of a shift in control, from buyers to sellers. Here's how it forms. The first candle is a large bullish candle that confirms buyers are still in control. This candle usually breaks above a previous high or continues the trend with momentum. The second candle is bearish, with a small body and a long upper wick. It shows that buy stop orders from breakout traders and buy limit orders from late buyers are getting triggered. At the same time, stop loss orders of early sellers, those who placed sell limit orders at resistance, are also being swept. Third candle is a strong bearish candle that completely shifts momentum. It often engulfs the second candle and in many cases closes deep into the body of the first candle, confirming that buyers are trapped and the reversal has begun. This isn't just a visual pattern, it's a liquidity trap wrapped in a 3-candle sequence. It's the moment where smart money sells into strength, sweeps the last round of retail buy orders, and then drops the market hard. Once you understand the silent drop, you'll never look at the top of a trend the same way again. Look at this chart. The market pushes up, hits this level, and pulls back, forming a clear resistance zone. Then price goes up again and taps that same level, but this time something different happens. The silent drop pattern forms. Here's how it plays out. The first candle touches the resistance and immediately triggers sell limit orders from traders, expecting the market to reverse again at that level. The second candle pushes higher, just enough to take out their stop losses. This is the liquidity sweep smart money was waiting for. Then comes the third candle, a strong bearish move that confirms the reversal. This is the institutional footprint, the real shift in direction. This is how smart money traps sellers and breakout buyers in the same zone and then drops the market. Now, once you spot this pattern, here's the trade setup. Enter at the close of the third candle, stop loss goes above the second candle's high, target the next support level. And what happened next? Exactly as expected. Price dropped cleanly to the target zone, delivering a textbook silent drop play. Let's look at another example, this time on the US dollar against the Swiss franc 15-minute chart. The market is trending up, with buyers clearly in control. Then it hits a key level and pulls back slightly. But on the next push, price rallies back into the level and forms a classic silent drop pattern. Now, here's where the trap begins. Retail traders see the breakout and think, this thing's about to fly, I'm jumping in. They enter aggressively on the first candle, while more conservative traders place buy limit orders waiting for a slight pullback. The second candle does exactly that. It pulls back just enough to trigger those limit buy orders. And then, the third candle hits. A sharp bearish reversal candle that wipes out the stops just below. That's the silent drop in action. A clean 3-candle sequence designed to trap buyers and reverse the market at the top. So how do you trade it? Place your entry at the close of the third candle, stop loss just above the high of the second candle, target the next support level. Now look at what happened next. Price dropped straight into the target zone, pulled back briefly, then continued dropping hard, giving you a clean, high probability move. The next candlestick pattern we're going to cover is one of the most powerful bullish setups you'll ever see. It's called the green wall pattern. The green wall is made up of 3 strong consecutive bullish candles, each one showing clear control by the buyers. The first candle is called the break-in. It's a large bullish candle that closes near its high. This candle signals the first wave of buyer strength, often appearing after a downtrend or a period of hesitation. The second candle is known as the builder. It opens near the first candle's close and closes even higher, with little to no lower wick. It shows there's almost no selling pressure. Buyers are no longer reacting, they're building a position with confidence. And the third candle is called the lockdown. It confirms the momentum with another strong bullish close right near the high. This final candle forms the wall, locking in demand and trapping any sellers still holding on. For the green wall pattern to be valid, the low of the third candle must be higher than the high of the first candle. This condition confirms a clean, aggressive push, showing that price left behind a pocket of inefficiency and buyers never looked back. So, how do you actually trade the green wall? Not like the average retail trader chasing green candles. You trade it like the professionals do, with patience and precision. First, wait for all 3 candles to complete. Look closely at the second and third candles. If their lower wicks are barely visible, and the third candle's low is higher than the first candle's high, that zone between them becomes your opportunity. It's not just support, it's a high interest area where institutions stepped in aggressively and left a footprint. That's your entry point, where price should return briefly before launching again. So you wait for price to pull back into the zone. But don't rush in yet. You need to see a clear rejection. That rejection tells you the zone is respected. The market recognizes it, and smart money is stepping back in. That's your signal. That's your entry. Now, let me walk you through a real chart example. As you can see, the market formed a clear green wall. Here's the break-in candle, then the builder, and finally the lockdown. And notice this, the low of the third candle is higher than the high of the first. That confirms it, this is a smart money zone. So what do? We mark that zone and we wait for price to come back to it. Look what happens next. Price pulls back into the zone and gets rejected. That rejection tells us the market respects the level. That's our signal. We place our entry at the close of the rejection candle. Stop loss, just below the zone. Target, the next logical resistance level. And watch how it plays out. The market takes off exactly as expected. When you use the green wall pattern, you stop seeing the market like a retail trader and start seeing it through the eyes of the banks. Just like buyers build the green wall, sellers construct the red wall. It's made of 3 strong consecutive bearish candles, each one showing clear control by the bears. The first candle is called the breach. A strong bearish candle closes near its low, showing that sellers just took over. The second candle is the pressure bar. It opens near the first candle's close, pushes lower and leaves little to no upper wick, showing buyers had no say. And the third candle is called the breakdown. It closes strongly again, right near the low. This final push confirms that demand has collapsed, and the wall is now pressing downward, trapping late buyers. For the red wall to be valid, the high of the third candle must be lower than the low of the first. This confirms a clean, aggressive drop, and leaves behind a zone of smart money activity. That's the area we watch, because if price returns there and gets rejected, we know the banks are defending it. Look at this chart example. As you can see, the market was clearly trending down, and then it began to accelerate. Right here, the market forms a strong red wall pattern. This is the first candle, followed by the second, and then the third, sealing the move. At this point, we draw our zone, the area between the high of the first candle and the low of the third. Now watch what happens when price returns to that zone. As you can see, the market gets rejected immediately. That's our entry signal. We place the entry at the close of the rejection candle. Stop loss goes just above the zone, and the target, the next support level. Ideally, the reward should be at least twice the risk, giving you solid risk-reward alignment. Look at what happened next. As you can see, the market went down after this pullback. So there you have it, another powerful pattern added to your trading toolbox. If you found this helpful, hit like, subscribe, and turn on the bell for more smart money strategies. Thank you for watching. See you in the next video.